The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Oh, happy Thursday, everybody. You're watching Squawk Box Show with the magnificent Juliana Tattlebaum and myself, Steve Sedgwick, and these are your headlines. So the US President Donald Trump he's denying plans to fire the Fed Chair Jerome Powell after reports that he drafted a dismissal letter and floated the move with lawmakers, but still hints the central bank chief could be out before his term ends.
I don't rule out anything, but I think it's highly unlikely unless he has to leave for fraud. He's got a very easy job to do. You know what he has to do? Lower interest rates.
Earnings skyrocket at TSMC, the world's largest contract chip maker, posting a massive 60% rise in net profit, beating estimates as AI appetite spurs demand for semiconductors.
Novartis raises its full-year forecast after a narrow core earnings beat in the second quarter, with sales at the Swiss pharma giant growing double-digit. We will hear from CEO Vasner Simon at 4:30 London time. And European Commission President Ursula von der Leyen plans to raise the bloc's next budget to €2 trillion, but faces stinging criticism from within Brussels and the European capitals over the content and handling of the package.
Good morning, how are you?
I'm doing well. I'm nervous now with that look from you.
No. What have you been reading? I have been, well, I'll tell you what I've been reading. How about that?
Okay.
What have you been reading?
What have I been reading? Like today or
Yeah,
generally? Well, today I've been reading the news.
Okay, good. That's a good start. That would help for our viewers. I have been reading the Harvard Gazette.
Okay.
Why, Stephen? Why? Because I was just wanted to confirm something that I'd read elsewhere, and the Harvard Gazette had the best article on it, which is the 1913 Federal Reserve Act. And I can see, hang on a second, you lot, don't go asleep and say, I'll switch over, this is boring. It's important, all right? I'm reading the Harvard Gazette because it's got a great interpretation of the original 1913 Act and the amendments thereafter. So look, just stick with it because you might learn something about whether Powell can be fired or not, you lot out there. I don't mean you know already. Right, okay, so this is the Harvard Gazette. The Federal Reserve Act of 1913 allows governors to be removed for cause. That's important, that last bit. But it doesn't say anything about the Fed chair. In your view, does the president, as head of the executive branch, have the power to oust Powell? Right, okay, so there are two separate issues. One is the statutory interpretation issue, whether the addition of the amendment of the Federal Reserve Act, hang on in there, in 1970s, which provided for Senate confirmation of the chair for a 4-year term, incorporates the for cause protection that the original Federal Reserve Act afforded to all members of the Board of Governors, etc., etc., etc. It's really interesting. So it's in the interpretation of the 1970s amendment for cause about whether Trump can fire Powell or not. And this is the crux of the legal argument. So that is important, okay, everybody? So you need to know that bit because it's for cause or not. And that's the interpretation of whether he can fire him or not.
I think when it comes to whether there is cause, the president has been attacking the Fed chair on two fronts. One, he wants him to cut interest rates. But two, and maybe this is where the cause comes into it, around what he says is a botched job around a $2.5 billion renovation of the Fed headquarters.
Yeah.
So there's two different streams of critique happening here.
I spoke to somebody about that. And they said, have you seen the building? Someone who is a Washington, D.C. swamp aficionado, someone very high up in Washington, was saying to me, have you seen the building, the work that needed doing on there as well? And actually, a lot of the original plans, including special elevators, beehives, roof terraces, that was all scrapped as well.
Yeah.
I mean, that's in as much as an account in the FT as well. But the person I spoke to said, look, you know, it's a lot of renovation needed, and a lot of the more ostentatious features weren't carried out actually as well.
They were dialed back.
Again, different interpretations of for cause as well. Let's fill in some details on this story because the president has denied reports he's planning to fire the Fed Chair Jerome Powell a day after he floated the idea with lawmakers. Speaking in the Oval Office, the president reiterated his criticism of Powell but said he has no plans to do anything.
I don't rule out anything, but I think it's highly unlikely unless he has to leave for fraud. I mean, it's possible there's fraud involved with the $2.7 billion renovation. This is a renovation. How do you spend $2.7 billion? And he didn't have proper clearance, et cetera, et cetera. So that's going on. So, there could be something to that, but I think he's not doing a good job. He's got a very easy job to do. You know what he has to do? Lower interest rates.
The president's comments came after he told a group of Republican lawmakers on Tuesday night that he would fight. I think one interpretation is he asked them, should he? Anyway, one interpretation is that he told a group of Republican lawmakers on Tuesday night that he would fire the Fed chair, according to a White House official, after asking the group whether they would back the move. Separately, the New York Times has reported that Trump drafted a letter to fire Powell, showing it to lawmakers during the meeting. Look, the dollar dropped sharply on this. Equity markets, I don't know what planet they're on, but they're ignoring all of this. The dollar actually dropped pretty sharply, 1.2% lower, I recall, when I was looking at it, before paring back those losses on the Trump denial. Equities, they did whipsaw a bit, but again, there's no dramatic move to the downside. And there may be a whole host of reasons why there isn't, and we'll get to some of our guests on this one as well. But equities whipsawed amid the uncertainty over Mr. Powell's future. And the news triggered a spike in long-dated US Treasury yields. So you've got the bond market reacting, you've got the foreign exchange market acting on the dollar, but the equity market just glibly doing its own thing. Goldman Sachs Chief Executive David Solomon gave CNBC his take on the reports surrounding Powell's future.
I think central bank independence, not just here in the United States, but around the world, has served us incredibly well. I think it's important. I think my comments here on Fed independence are with respect to monetary policy. I think regulation and supervision are different. But with respect to monetary policy, I think central bank independence, Fed independence is very important, and it's something we should fight to preserve.
Diamond the day before, Solomon there. I mean, you tell me, ladies and gentlemen, who are the most powerful 5 or 6 men and women in Wall Street? Well, you put those two in there as well. And if Wall Street doesn't want the oscillation that could come from a non-independent chair of the Federal Reserve, now's the time to speak, because now's the time to do it before it happens as well. And it's very interesting that both two of the most powerful 5 or 6 gentlemen on Wall Street coming out very clearly and saying independence has served us well.
I think Jamie Dimon coming out is certainly notable, and also David Solomon. But Jamie Dimon, we know back in April when we had the bond market volatility, it was him who came out warning the president that we were going to see an issue if he didn't rein it in on tariffs, and reports suggest that he actually was a pretty pivotal voice in the president's ear. So I think his words really do matter.
Can I just tie a few other bits in here as well? And I don't want to be critical. I want America to do well. But if you've got the tariffs bringing in vast amounts of revenue and providing great income for the United States, if you've got the one big beautiful bill and the tax cuts for certain parts of the US being such a pivotal part about driving growth as well, if you've got the overall trade and tariff policies driving growth back to America, 101 economics says you don't need rate cuts.
You don't need to cut rates.
And the president is a real estate guy. He knows this better than I will ever know this. And I'm not trying to tell, but the fact is, if all of these policies are pro-growth America, you do not need the extra stimulus of a rate cut.
I think that is spot on if you're looking at this from an economics 101 perspective.
For sure.
But
and it's naive if you're looking at it from a politics point of view.
But if you're looking at it from a politics point of view, what matters to Trump voters? What matters to the average American? Their mortgage certainly matters. Mortgage rates tied directly to Fed rates. And I think that's a critical piece for President Trump moving forward. Let's take it back to markets. You talked through some of the intraday moves. Here's where things landed after that session. To Steve's point, we did see a bit of oscillation in equity markets, but by and large, we still traded in a pretty tight range. All three of the majors ended up over the course of the day. The Nasdaq added about 1/4%, about 1/3% higher for the S&P 500, and the Dow Jones advanced as well. So equities continue to climb higher. In terms of Asian trade overnight, a lot of focus on TSMC. We're going to get into those numbers a little bit later in the program. In terms of the overall index levels, you got the Nikkei 225, the Hang Seng over in Hong Kong, the Shanghai Composite, and the Kospi all trading higher. As for European trade this morning, this is a picture of what futures look like. Very strong gains indicated at the open. Wow, we're looking at a 1% jump in the CAC 40, a 1% jump in the FTSE MIB, the DAX, the FTSE 100 also looking at stronger starts. So my, oh my, what a strong start indicated for European trade after yesterday the Stoxx 600 ended lower for the fourth session in a row.
Volvo Cars posted a sharp decline in operating profit in the second quarter, 2.9 billion Swedish krona compared to 8 billion a year ago. Gross margin fell to 13.5% from more than 18% in the first quarter, as US tariffs began to bite, whilst revenue came in ahead of expectations. The CEO is a familiar face because he's back now. He was the CEO, then Jim Rome was the CEO, then Jim Rome got sacked, and Håkan Samuelsson has come back. He told Sylvia on the show before this, the excellent Europe Early Edition, how the company is looking to adapt to trade tensions.
You have to divide very thoroughly between trying to predict where we will be in a year or two. That will be very difficult, but it's better to concentrate on what should we do, what type of action should we do. And then it comes down to we should be more regional, we should have stronger regions, we should produce closer to our customers, we should continue developing electric cars, etc. Those are things, despite a very turbulent environment, it's easier to come to a decision on that. And that is at least how I think. So I don't think too much about forecasts. I think more about what actions do we need to take right now.
Renault shares saw their second worst day in history. Second worst day in history in yesterday's session after the car maker. Wow, 18.5. It was down mostly 16% during this show yesterday, but 18.5% lower after the car maker cut its full-year guidance. The company said it expected lower profit margins than previously forecast, citing a weaker environment in Europe. Really great to have Stefano Aversa joining us now, Global Vice Chair and Chair of EMEA at Alex Partners. Stefano, thank you for joining us from the most magnificent city on the planet, there's no doubt about it. Look, Renault's in a pickle. There wasn't a highly priced stock to begin with. It was only trading on 5.7 times forward before the announcement. Just give us your views on what's happened and what you think of the company now, sir.
Well, talk about Volvo now.
I beg your pardon, sir?
Yes. Okay. The whole situation of the automotive industry is a bit in a turmoil at the moment, and not only because of the tariffs, which are affecting mostly companies that export in US. There are companies like Renault who announced a profit warning yesterday, and Renault is not affected by that. There are certain uncertainties about the EV who has reduced their growth. They are now at 15%. They were about 13% before, but is growing pretty slowly. The whole market in Europe, in EMEA region, we expected as Alex Partners to be muted, and the muted has been. We are minus 0.6%. It could have been maybe plus 1%, but it's decreasing. So, and also the discounts has been increasing. If you add up, all these points, so the volumes, the uncertainty on the exports, who is going to pay for these tariffs, the lack of incentives, and finally, the volumes themselves and the retail being pretty muted, you can expect certainly a difficult first half, and I do expect still a very uncertain second half of the year for the automotive. Having said that, maybe it's worth saying that we are coming from 2002, 2003, which have been record year in terms of profitability. So relatively speaking, we are still not in a bad place, except few specific situations.
Right. Stefano, Renault was one of the few OEMs that didn't profit warn for 2025. So that's part of my understanding. That's part of why we saw the major negative share price reaction yesterday, because they had been holding up a lot better than peers. What went wrong in terms of their ability to guide? Clearly, they hadn't guided properly, and hence the profit warning.
Yeah, and as you correctly said, Renault was one of the very few that did not give any guidance that was reduced compared to before, and it did it now. Now, the fact that they do it when the CEO left and a new one will be soon nominated, it's pretty typical. When you have a change of CEO, you tend to lower the expectation until the new CEO gets his bearings and decide the new business plan, the new strategy, or confirming the previous strategy. So that's number one. Number two, I think we should put it in perspective again. About 5 years ago, in 2020, the company lost 8 billion in terms of net profit, and now is making last year made 1 billion. And in terms of EBIT margin, it went from -5 to +5 last year. And here we're discussing if it's 7%, which was the previous guidance, or 6.5%. Yes, it is a decrease, but I don't see that by any means a dramatic change or shift. It's just a relatively minor adjustment if you put that in the perspective of the strange world we are in.
Stefano, this is a lowly rated sector in terms of valuation. What do you think is the best play for our viewers in the auto sector at the moment?
Well, within the auto industry, there are areas that are growing significantly. Certainly, South America is doing pretty well in terms of region of the world. So it does part of Southeast Asia. Much less so Europe. US is actually doing very well, but this is contingent to the fact that people is expecting the tariffs to take effect. So consumers are anticipating the purchase. And also China is not doing bad at all. It's been reducing a bit the growth, but still growing. So that's geographically. And from a technology standpoint, if you look at some suppliers that work in the software, electronics, not necessarily battery, but more into the sensors, they have very, very high profitability, and they are growing because all this area that will make the car more of a iPad on wheels with large screens, high interactivity, and sensors to be more autonomous on the road. Will continue to be attractive.
Yeah, we've seen some of those new features, and they certainly are enticing. Stefano, thanks for joining us this morning. Stefano Aversa, Global Vice Chair and Chair of EMEA at Alex Partners. Coming up on the show, TSMC tops analyst estimates to post a record quarter with net profits surging more than 60% to almost 400 billion Taiwanese dollars. Also ahead, farmers versus firepower. Ursula von der Leyen comes under fire as the EU announces its next budget. We'll bring you the details next. And we'll hear from Investor AB CEO Christian Cederholm as the firm reports its half-year earnings. Don't miss that conversation coming up at 8:30 London time.
Okay, time to recap on some of the top corporate results in Europe this morning. Novartis has raised its forecast for full-year core operating income, now seeing growth in the low teens. Net sales came in at just over $14 billion for the second quarter, narrowly beating analyst forecast. Staying in Switzerland, ABB flagged continuing tariff uncertainty on the horizon as it beat analysts' forecasts in the second quarter, posting a 9% jump in core operating income to just over $1.7 billion. Swatch posted a huge miss, actually, on first half operating profit, down two-thirds on the year at 68 million Swiss francs versus the more than 130 million expected. The firm said the sales decline is down to weakness in, I don't even have to tell you anymore, do I? Weakness in Greater China, which generated 27% of sales, but the revenues in other regions actually reached record levels, including double-digit growth in North America. Wowzers. And in Paris, Publicis has raised its revenue growth outlook for the full year after topping expectations in the second quarter with better than expected growth of just under 6%. I'm going to just dwell on that for a second because Publicis upping their estimates after WPP got wiped out on theirs just a week earlier is quite interesting, I would suggest, as well. And now, of course, paints a very mixed picture about the global ad spend.
Well, thankfully, Charlotte's been digging into the Publicis numbers, so we'll talk through those in more detail a little bit later in the program. Now let's turn to TSMC. This is a huge name, obviously, in the chip space. The company posted a record quarter in Q2 with profits surging a better than expected 60% to just under 400 billion Taiwanese dollars. Arjun's been pouring through the numbers this morning. Arjun, obviously this goes without saying, but TSMC, a major player here, the world's largest contract chip manufacturer. NVIDIA is one of the key customers for TSMC. Talk us through the numbers. They look pretty good from what I can see.
Yeah, it's a company that basically makes the chips for all the biggest companies out there right now. And there's a few things we've learned, I think, from looking at the numbers. One, we're seeing this huge boom in the cutting edge of chip manufacturing. That is the so-called 3 nanometer and 5 nanometer chips, which account for around 60% of revenue. If we just break that down a bit further, 3 nanometers are around 24% of revenue, and that's thanks to companies like Qualcomm and of course Apple, which is preparing to launch their next iPhone. So probably some of that chip demand is coming from the smartphone players there as well. Then on the 5 nanometer, that was around 36% of revenue. These are NVIDIA's latest chips, and of course AMD and others as well feeding into that. The second one is that this is a company that continues to benefit from the AI boom and demand we're seeing, especially for the chips coming from NVIDIA. The high-performance computing unit was 60% of revenue. That was up from 52% in the last quarter. So you can see how much now that is accounting for the TSMC business. The revenue in that segment was up 14% on the quarter. Again, that is the NVIDIA chips that TSMC is making. And finally, 75% of TSMC's customers are from North America. So that, again, is all of these companies I mentioned. Qualcomm, Apple, NVIDIA, AMD, and China is accounting for less and less of TSMC's revenue, likely because they're not the ones being able to purchase these very expensive advanced technologies from TSMC at this point as well.
The pressure is on TSMC to build fabs elsewhere. In Japan, I think Dresden was mentioned in the copy here as well, and in the United States, of course. The margins, they wouldn't have built them previously in Taiwan if that's not where the margins are, if that's not where the ecosystem of supply chains are and what have you as well. We know how one creates industrial hubs. So how much are these extra facilities in other countries going to cost them in terms of margin, do you think, going forward? Because they're under a lot of political pressure to do so, but is it making economic sense for the company?
Yeah. That's a great question, Steve. When you look at the margin, they're commanding near a 60% gross margin.
60%
right now.
Margin.
Yeah,
Goodness
right
me.
now, near a 60% growth. And that's been increasing when we look at that. And that is because they're continuing to get customers to purchase chips on their leading edge manufacturing. The big question is, as they do expand those manufacturing hubs, the reason TSMC has been so successful in Taiwan, it's built up over decades experience, a whole ecosystem of people in the know how to build these chips, engineers who can run these fabs effectively. When they move that over to the US, that's going to come with a cost in terms of one, trying to find the talent, but two, possibly having to get talent from Taiwan to come over to the US, not to mention some of the potential labor costs. So there is a concern here that this is going to weigh on some of those margins. I guess the big question is, are they going to be able to charge any more to Apple if they're saying, hey, look, you want your chips to come from the US, we've got a fab here, but we're going to have to charge you a little bit more for it because that's just our cost of business right here of doing that. So that is still a big unknown. But certainly I think expanding into the US, expanding into Europe will come with some extra costs for TSMC when it comes to being able to set those factories up.
Did TSMC say anything about customer behavior in response to tariffs, the threat of tariffs? Are they seeing any notable changes yet?
At the moment, I haven't seen any commentary on that. I think the big concern for TSMC around tariffs is the end demand, right? So they are making the chips that effectively go into the end products. If there is a knock-on demand to an iPhone, for example, or smartphones more broadly, if there's knock-on to demand for chips that go into the data centers, that's going to have an impact more on TSMC, I think, than anything. Of course, if they are exporting these chips from Taiwan over to the US, that's another potential here. But a lot of the assembly of these products are happening elsewhere. For example, you think about the iPhone, TSMC is making the iPhone chips that then go to China. They're assembled in China or India and then sent back to the US and elsewhere as well. So it's very complicated. It's a very complex supply chain for TSMC.